With more than 6,000 small and micro-cap companies listed, if you're looking for the next Apple at the earliest stage, then channelchek truly is the orchard. The listed companies support channelchek, so it's free for you, the potential investor, to gain access to institutional quality research from FINRA licensed analysts, advanced market data, industry reports, news, and a growing catalog of videos and webcasts. Make sure to subscribe to our YouTube channel and register for channelchek so you're always up to date on what's going on at the small and microcap data place. Welcome to the virtual Roadshow series presented by channelchek. This Roadshow features Andy Wiederhorn, President and CEO of FAT Brands, NASDAQ ticker symbol FAT. Following a formal presentation, he is joined by Joe Gomes, Senior Research Analyst for Noble Capital Markets, a FINRA-licensed, SEC-registered broker-dealer, for a Q&A session featuring questions that were submitted by the live audience. You can find Noble's research on FAT Brands on channelchek.com or by clicking the link in the description. With that, I am pleased to present Andy Wiederhorn.
Thank you, and welcome to the FAT Brands presentation. Just for an overview of what FAT Brands is all about, we are a global restaurant franchising company. It's an asset-light business model, which means we do not own and operate the restaurants, and all of our revenues are from royalties and franchise fees. We grow both by organic growth, that's building more restaurants from our existing base of franchisees and new franchisees, as well as acquiring additional brands and boarding them onto our platform and wringing out the synergies of adding a brand and eliminating things like the departments that are duplicative, the legal department, the accounting department, and so on. There's tremendous opportunity there to eliminate duplicative overhead, and I'll give you some examples as we go through the presentation of where there's real savings. Essentially, we can buy brands at maybe 6, 7, 8 times cash flow and end up paying only 3 or 4 times cash flow once the synergies kick in, usually within 30 days or so. We've acquired 11 different brands since FAT Brands was started, and we have a history of merging them quickly onto our platform and really delivering great execution. So our management team also has done this so many times now, it's really a cookie cutter way of business. Our management team has significant restaurant experience, and I'll go through that with you also. Just to give you an overview of our size today, we operate 9 different restaurant brands across 36 countries and 37 US states. And that's made up by 321 different franchisee owners. 85 of them are multi-unit operators, so they own anywhere from 1 to 25 restaurants. No one owns more than that, so we have plenty of diversity amongst our franchisees. There are 646 restaurants open today, and 38 more are under construction presently that are expected to open this year. We also have a 200-unit pipeline that's been paid for by our franchisees with development plans to open over the next 4 or 5 years, basically 40 or 50 restaurants a year already locked in for the next 4 or 5 years. Here's a description of the different brands we own today. Fatburger is our flagship brand that started in 1947. We acquired the brand back in 2003. There are 181 Fatburger locations today all over the world. Johnny Rockets we acquired just 9 months ago from Sun Capital Partners, and that brand started more than 30 years ago in California, and now today is all over the world as well. There's more than 300 Johnny Rockets locations. Buffalo's Cafe and Buffalo's Express, it's a wings brand with a full casual dining restaurant and bar and a full menu. There's steaks, chicken, and seafood, as well as chicken wings at a Buffalo's Cafe, and 13 locations primarily in the state of Georgia. Hurricane, and there's 100 co-branded Buffalo's Express locations, which is really similar to a Wingstop with our Fatburger locations. Hurricane Grill and Wings is just like Buffalo's Cafe. It's a full casual dining restaurant, separate bar, separate dining room. The menu for Buffalo's Cafe and Hurricane Grill and Wings are virtually identical. If you put a blindfold on, you probably wouldn't know which restaurant you were in, but it has more of a beachy theme where Buffalo's Cafe is more of Cowboys and Indians or Route 66. Ponderosa Bonanza, our steakhouse chain, 48 locations. It started back in the 1960s. Ponderosa is a long storied restaurant chain with a steak or piece of chicken and all-you-can-eat salad bar, pasta bar, things like that. Ponderosa we acquired in 2017 as part of our IPO. Yala Mediterranean is an organic Mediterranean brand featuring healthy Mediterranean food based in California. A lot of white space here and opportunities for growth with the Olive brand. Elevation Burger we acquired in 2019. It's an Australian grass-fed beef concept up and down the East Coast, featuring French fries fried in olive oil and milkshakes that are vegan. And it's really the healthy brand amongst our portfolio here today. So what we do for a franchisee is virtually everything. We help them find their location. We design their restaurant. We set up their supply chain. We train their staff. We do all of the PR, digital and social media for them, and also financial planning. So for us, the key to success is the financial success of a franchisee, and all of our time is spent coaching our franchisees on how to maintain the proper margin, how to take price, how to watch their costs, and how to measure that on a weekly basis or daily basis. Not wait till the end of the month and see what your P&L is 3 weeks later when you could be losing money and already losing money for another 3 weeks. So it's very important that we coach the franchisee. We view the business as the franchisee as our customer. That's who pays us a royalty every week by ACH or by wire transfer. And so it's critical that the franchisee makes money. Of course, the end customer eating a hamburger or chicken wings or whatever is critical to the success of our business, but the franchisee's financial success is our primary focus. This platform is very scalable as we continue to add brands to the platform and add more franchisees to our different departments and our functions. And we look forward to that with coming acquisitions that are planned this quarter and for the rest of 2021. Just want to talk about a couple of acquisitions as examples. The Hurricane Grill and Wings concept is a perfect example where we acquired this brand in 2018. Same-store sales were down 4.7%, and by the end of 2019, same-store sales were up to more than 8%. And so that's a huge swing, 12-point swing in same-store sales during that period of time. And to enable that integration, think about the economics here. When we bought the brand in 2018, Hurricane Grill and Wings had $4 million of royalty income and $3 million of overhead and $1 million of EBITDA. 30 days later, post-transaction, it had $4 million of revenue and $1 million of overhead and $3 million of EBITDA. And we paid $12 million, so it was 4 times EBITDA for this business, but it looked like it was 12 times EBITDA at pre-synergies. So it's very important that we can wring out those synergies and eliminate the accounting department, the legal department, the corporate headquarters, board it onto our purchasing platform where our franchisees get a benefit of 3% lower food cost, being a member of the Fat Brands family instead of being an independent chain. Very similar results at Elevation Burger, which we bought in 2019. $2 million of revenue, $1 million of overhead, $1 million of EBITDA, and post-acquisition, $200,000 of overhead and $1.8 million of EBITDA. So very successful acquisitions. Similar story at Johnny Rockets. We were able to cut the overhead from $10 million to approximately $2.5 million. This integration was really something to focus on. We approached these integrations with a 30, 60, 90-day process of meeting the franchisees, learning about the brand from their perspective, and then coming up with an implementation plan and any pivoting that we're going to do with the brand. For example, Johnny Rockets, some of the low-hanging fruit was implementing plant-based proteins and third-party delivery, things that Johnny Rockets really wasn't doing well. And on the plant-based protein side, they didn't have any. We introduced the Impossible Burger across the system in the US and internationally beyond meat. It's been a very successful integration in a short period of time and during COVID. We also introduced an in-store music program, which is a little bit more modernizing for Johnny Rockets. Our development pipeline is really something interesting. In 2020, we organically grew, adding 62 stores, as I mentioned earlier. And with that 200-store pipeline, this really gives us a balanced effect of not needing to make acquisitions to grow, but growing the brands by cross-selling them, selling co-branding, and helping our franchisees with development plans and financing to build more stores and pay us more royalties. We also did a healthcare initiative during 2020, donating 35,000 meals in Southern California using our Fatmobile food truck to cater to the hospitals and all the other vaccine locations during the COVID era. Just to go over some numbers quickly, we completed a whole business securitization, the most recent one, our third securitization in the last 12 months, on April 26, raising $144 million. Our previous securitization was $80 million. So this left the company with more than $50 million in cash. We paid down a little bit of debt, and it reduced our cost of capital by almost 3%, from 8.75% to 5.92%, almost 300 basis points. So basically the same cost for $60 million more of cash. It gives us plenty of capital to make incremental acquisitions in addition to using stock or growing our securitization facility. Our 2020 financial highlights, you can see how revenue has rebounded, our EBITDA has rebounded back to more than a 32% margin, on its way to a 50% margin when the rest of our stores are open, and how our royalty income has grown solidly. Pre-pandemic, we were running close to a $9 million EBITDA rate before the acquisition of Johnny Rockets. That's taking our 2019 adjusted EBITDA and adding a full year of Elevation Burger. We only owned it for about half a year. So that was $7 million in reported adjusted EBITDA earnings, adding another, or $8 million, adding another $1 million for a full year of Elevation gets you to $9 million. And then with Johnny Rockets, we should be up in the $18 to $20 million range on a post-pandemic basis, whenever that is, whenever COVID's over and the restaurants return to normalcy. So we're very excited about that. This next slide just talks about some of the highlights of our system-wide sales. Presently in Q1, 114 million. On an annualized basis, post-COVID, they'll be close to $700 million. And that EBITDA, like I said, should be somewhere between $18 and $20 million. You can see the sales improvement here as it's bounced back rapidly from Q1 of 2020 to Q2 of 2020 and all the way back now, Q1 of 2021 up to $114 million. So really seen a big comeback. We still have about 98 restaurants temporarily closed out of almost 700. And that'll be a big rebound in sales and revenue shortly. You can see the weekly numbers here as well on this next slide. A big part of the performance during the recovery was delivery and to-go, and the integration with Chowly and Hunger as providers of third-party delivery services and integration into all the third-party platforms like Uber Eats, Postmates, Grubhub, and DoorDash. And today, virtually all of our restaurants have third-party delivery. It's only the steakhouses that really don't do that. And you can see the tremendous growth in third-party delivery sales at our Fatburger locations alone here, during the pandemic and before and after. Some key strategic initiatives are to, in addition to third-party delivery, also implement virtual kitchens. That's where we let our restaurant operators sell additional brands out of their existing restaurants. So you might operate a Fatburger and a Buffalo's Express as a co-branded location, but you could also sell Hurricane Grill and Wings out of the back door for delivery only. And just getting more use out of your kitchen for third-party delivery, it's incremental revenue to the franchisee and incremental royalties to Fat Brands, and customers have more choices. We've been co-branding, like I said earlier, we have more than 100 of our restaurants co-branded with like a Fatburger Elevation Burger, a Fatburger Buffalo's Express, and we plan to continue to co-brand it. It's been very successful for us. We've been doing it for some time. We also have a CapEx remodel program underway. Our studies show us that whenever a restaurant is freshly upgraded, it can see anywhere from a 40 to 100% increase in sales. Capital is cheap today for franchisees, so we're encouraging them all to keep their restaurants looking fresh. Menu innovation, like we've talked about, adding plant-based proteins, Craig's vegan ice cream, vegan cheese, vegan whipped cream, things like that, Impossible Burger, Beyond Meat. Those are important options for franchisees to have, be innovative with their customers and give them other options rather than just beef or just chicken. Our management team, just as I conclude here, is very experienced. We added 3 senior members of our management team just in the last couple of months. Ken Kuick, our new Chief Financial Officer, very experienced from Noodles & Company. Alan Sussman, our General Counsel, a longtime partner at Loeb & Loeb. And Rob Rosen from Black Diamond Capital Management, running our capital markets. 3 very experienced additions to our senior management team. And we also have a very prominent independent board of directors. Ed Renzi, our chairman of the board, is the retired president and CEO of McDonald's, 31 years at McDonald's, 16 years as president and CEO. So just a wealth of information and good governance.
Thank you, Andy. Great presentation. I'm Joe Gomes, the Noble Capital Senior Analyst who covers Fat Brands. Here are the questions I've selected from the audience, as well as a few of my own. Now, Andy, since you just finished up on the new hires, let's start there. Why don't you talk a little bit more about them and a little bit about what they bring to the table for Fat Brands?
You bet. So Ken Kuick, as our new Chief Financial Officer, just came from Noodles & Company, a $500 million market cap business. Wealth of experience in the restaurant industry and as a public company Chief Financial Officer. And as we plan to grow our platform significantly this year and next year, we felt we just needed that additional heavy lifting and help with it. And Ken is an excellent resource for that. He has a wealth of experience. Before that, he was at Caesars, and he was at a large REIT called VC. And so I think Ken will be a great addition to our team and helping us integrate these acquisitions. Then Alan Sussman, our new general counsel. Alan's been on our team for years. He led us through the IPO process from Loeb and Loeb and all the different registration filings and capital raising initiatives that we've completed, including our securitizations. And having him in-house just makes it very easy for our team to have full access to him all the time. And then finally, Rob Rosen, who came from Black Diamond Capital Management. Rob's an expert in securitization. We're using our securitization vehicle constantly to fund our new acquisitions. And so to have someone on board who can handle that full time really frees me up to be executing on the business and the integration of the acquisitions that we're making.
That's great. Sounds like some really solid hires here for the company. Now, I was reading an article on Black Box Data, and they were saying that, April was the second consecutive month of stronger sales than in the same period of 2019. But they also noted the improvement was due to higher check, as traffic has not yet recovered to a number of outlets. Can you give us a little bit how's that look at Fat Brands in terms of traffic versus just check recovering that is driving revenues higher?
Right. Well, we're seeing both. We're seeing growth in check and we're seeing growth in traffic. Now, you have to think about where our restaurants are located. Our Hurricane Grill and Wings brand and our Buffalo's Cafe brand, located in Florida, Georgia, Texas. Those brands are doing 110 to 120% of their 2019 numbers. They're just killing it. Part of that was from an increase in delivery and to-go business during the pandemic. And then when the dining rooms reopened early on, right? Those are states where COVID didn't really exist. When those restaurants opened up early on, then all the customers came running back to the restaurants, and they had an increase in delivery and to-go business because there was such an increased awareness of it. So that really boosted sales. And we, there's a little bit higher average check just from the creep there that's gone on with costs, and also from the delivery services, which lead to a higher check. But mostly it's just pure sales growth. On the Fatburger side, we've definitely seen an increase in average check, and that's primarily because of delivery. You have delivery charge, and the average check on delivery is $24 versus $17 in the restaurant. So we've definitely seen an increase with delivery going up to 85% at the peak of the pandemic. But even today, as delivery has slowed down and customers are coming back into the restaurants, as California has reopened, we're really seeing those numbers hold firm. Sales are positively comping above 2019, above more than 5%, close to 10% on the Fatburger side. So it's not just price, because we haven't taken a 10% price increase.
Great. So one from the audience here, what are recent comp store sales at the steakhouse restaurants, and do you expect them to survive?
Yeah, great question. The steakhouses have really gotten kicked hard, and that's a function of the dining rooms being closed for so long. And those are older restaurants, older operators. We had a number of closures during the pandemic. We made a reserve for the entire brand on our balance sheet at the end of the year and in Q1. So we're not carrying the brand on our balance sheet, but it's still paying us more than $1 million a year in royalties. And there's still half of those restaurants are temporarily closed. So we have about 50 restaurants left today, and about half of them are temporarily closed. I think that they'll all fully reopen here in the coming months. But even if that brand is paying us $1 million to $1.5 million a year in royalties instead of $3 million in royalties, we financially reserved for it. It's less than 8% of our revenues, and it's not going to really beat us up anymore. But that's sort of the current state of Ponderosa and Bonanza.
And you mentioned a little bit about menu innovation, and I know that you've been doing a lot there at Johnny Rockets. Can you talk a little bit about the acceptance rate of that and where else you think you might be able to go there with menu innovation?
You bet. So, for example, we introduced in Fatburger this concept of chicken wings. That's a plant-based chicken, calling it chicken wings, not chicken wings. And that's an example of menu innovation where if someone doesn't want to eat beef or doesn't want to eat chicken, they can get an Impossible Burger, or they can get plant-based chicken product. And they also have chicken, like a chicken nugget product. And if they don't want to have it on the bone. And so it's really an interesting product, and that's innovation in and of itself. Introducing a vegan milkshake or vegan ice cream across our brands. Johnny Rockets has got vegan milkshakes now, and our Elevation Burger has vegan milkshakes. That's where you're really creating a product for the customer to come in and get. And a lot of customers don't know that you even have plant-based protein when your name's Fatburger or your name's Johnny Rockets. They don't even think of that. Johnny Rockets used to have a black bean burger on the menu, which it still does. But adding the Impossible Burger, we sold over 1 million Impossible Burgers last year across our brands, and that shows that there's real demand. And so, we think that that's an easy way to keep moving forward on menu innovation. And of course, there's continuing new products to try, but we're trying to keep these menus fairly simple.
Okay. Another one from the audience. Could you please speak to the opportunities for growth for the Fat Bar concept, as it seems with the new relationships from the Johnny Rockets acquisition that the Fat Bar concept should excel in cruise, airports, and international locations, etc.?
Well, when there are bar opportunities within the restaurants, I mean, Hurricane Grill and Wings is a very big bar business, and so is Buffalo's Cafe. Fat Bar, there's really just one or two of them around the world, the primary one being in Las Vegas. But there are some opportunities to have, a lot of our Fat Burgers have beer and wine available, and there's opportunities for some of these to have a full bar, outdoors or indoors, depending on the venue. Definitely on the Johnny Rocket side, there's tremendous opportunity there because they're in so many special venues, airports, amusement parks, things like that. And also on the Fat Burger side, we have some new development deals opening up in France, Paris to start with, but all over France, also in Mexico. So I think that you might see some more bar business there.
And a couple here on acquisitions, mostly to do with the types of concepts you're interested in acquiring, and kind of combine that with one of the questions is that given your stated plans for acquiring brands for further growth, it seems that Buffalo's and Hurricane brands, in light of the market values on brands like Wingstop, represent real opportunities for organic growth. Would you agree? And is this an area of priority from your perspective?
Yes, I think you're going to see us add to the wing brand category very soon, as well as other brands that we've been in talks with. But the wings category makes a lot of sense to continue to roll up these, what I'll call regional wings brands, where their name and their relationship in the market is well known in their community. It's fairly easy to standardize their purchasing and in some cases improve their food quality and get everybody on the same sort of menu, but it's different logo and different branding in each market. The bar business is separate and pretty straightforward, and having additional wings brands with bars, the full casual dining restaurants, extraordinarily resilient during COVID-19, and the bounce back to 120% of normal sales is really something. So we definitely want to add there.
And kind of continue on in the theme with the acquisition. So, you mentioned about the refinancing of the whole business securitization and the additional funds that provided over and above what you needed to actually refi. And then last week you filed about the potential sale of some Series B preferred. Can you give us a little more detail as to the filing from last week and where you would see, in your mind at least, in an acquisition of where the funds would be coming from?
Yeah, sure. So the securitization that we completed at the end of April raised an additional $50 or $60 million of excess capital. We've paid down a little bit of debt from the merger, and getting the merger done itself at the end of last year with our controlling shareholder, Fog Cutter Capital Group, allows us now to preserve our net operating loss carry forward. We have a $100 million NOL carry forward, which protects us from federal taxes and some state taxes. And being able to have that merger behind us means we can now use common stock to make an acquisition if we want to, and to raise capital if we need to for whatever reason, from common stock, let alone preferred stock. So we filed last week a $500 million shelf, which is good for 3 years and will enable us anytime to issue more preferred off the shelf or more common off the shelf if we like the price in the market. But we also filed a $10 million preferred stock offering, and that stock pays an 8.25% dividend on a monthly basis. It trades on the NASDAQ, symbols FATBP for preferred. And that's really a good opportunity for investors to get yield. And that capital, because it's a perpetual preferred and it's got a 4-year prepayment penalty or call premium, so investors can lock in that yield for some period of time, it allows us to have additional capital to make some acquisitions that we have planned coming up for Q2 and Q3.
Thanks for the insight on that. Another one from the audience. Given the back to work push that's going on right now, how's that impacting your lunchtime traffic? You seeing some improving trends there?
Sales over the last month and a half are reaching all-time highs in some of the brands, in the Fatburger brand, and the Hurricane brand, Buffalo's brand. So we absolutely are seeing an increase in lunch traffic, as well as maintaining delivery and to-go business. So I think that really increased the awareness for consumers. And then some of these new menu offerings, it's working like on all cylinders right now. We're definitely feeling the labor pinch. We're definitely feeling, the commodity price spikes, but those will go away. Those things will settle out over the summer. The stimulus will go away, and I think that we'll see, a better margin come back into play.
That's good news. So you mentioned during the presentation about, if you took the pre-pandemic numbers for Fat Brands and layered in pre-pandemic numbers for Johnny Rockets, what you would expect in the revenue and adjusted EBITDA. And if we took the midpoint there, that's about a 54% adjusted EBITDA margin. As you layer in additional concepts to the platform, do you think that margin can go higher? And if so, how high do you think it can go?
Yeah, I really think it can go into the high 60s or low 70s on an incremental basis, because all those public company costs, which are expensive and fixed, don't really continue to increase. Adding a new CFO, having the right insurance program, and the public company auditors, those things are all expensive, but they plateau out at a certain point. And so as we grow revenue, we really don't have a proportional increase in overhead. Each brand comes with its own marketing people, its own field operations people, but there's no real incremental corporate overhead. Maybe an audit of each brand on an annual basis, but that's not a big number. So absolutely, that margin should go up into the 60s, knock on wood, pretty fast.
That would be fantastic. Now, when you acquired Johnny Rockets, you also acquired ownership of, I think it was about 9 locations. How is the push going to refranchise those units?
Yes, we have almost all of them in escrow today, and we sold 2 already. We have several more ready to close in the month of June, and it's possible we close them all that month in terms of sales and transferring ownership to franchisees. So they're all planned to be refranchised very shortly.
And you recently announced that you reinstated the dividend. Can you give us the thought process behind that?
Yeah, so originally we started with a quarterly dividend at Fat Brands as part of the IPO, and something we wanted to pay to all shareholders evenly and try to keep compensation, executive compensation, moderate, and pay out a dividend equal to everyone. Certainly our family is the largest shareholder, and we felt like it was a more appropriate way to distribute cash from operations and also to reinvest money. And so it's a percentage of the cash that the business will generate, and it should end up being a quarter to a third of the cash we generate. And as we grow and grow, the dividend, it doesn't really need to grow by much, but it can grow proportionately. But I think that it's a way to reward shareholders on an ongoing basis. And so I think that you'll see us declare another dividend here for Q2, and as we did for Q1 a few weeks ago, and then away we go.
With the Fog Cutter Capital merger at the end of last year, the increased float, are you seeing some more interest from the institutional side in terms of investments?
Yeah, so I mean, look, we all know in the last 12 months, our stock's up 400%. It's done very well. Investors are obviously very happy, and the merger was a big success, and we issued some preferred stock to the common shareholders, and I think everyone's very, very happy with that. The preferred stock itself is traded up by more than 20 or 25% over that period of time also. So really good execution there. Having institutional sponsorship on the preferred side and also on the common is very important to us. And I think that as part of the shelf offering and part of the new filing and part of the acquisitions that we're making, where some sellers will take stock, is really going to help bring an institutional following into the company and grow. We really want to get away from being a micro cap, and we're not that far from doing so. And I think you'll see that happen here in the coming couple of quarters.
Thank you for joining us for this virtual roadshow presentation brought to you by ChannelChek. View our YouTube channel for more video content, including C-suite interviews, virtual roadshows, and conference presentation replays. New content is added regularly, so subscribe below to stay up to date. Visit channelchek.com or click the link in the description to access equity research, news, and advanced market data on this and 6,000 other small and microcap companies.